Welcome to the Stock Market Palantir. Today we are going to talk about GELS. Gel Tech Limited. It's an Australia-based clinical stage biotech that's working on something genuinely interesting, proprietary ingestible gels. The idea is to dramatically boost how well drugs are absorbed and, make them easier for patients to take. But this stock, it presents one of the most, stark contradictions we've seen. It IPO'd just over a year ago, October 2024, at $4. Today, it's bouncing around between 88 and 97 cents.
A classic fallen angel story, it seems.
Exactly. And that's the core conflict for us today. There's this massive gap between GL's proven technological validation on one hand and its severe, truly existential financial fragility on the other. So the real question is, does the scientific potential of their hydrogel platform, which is frankly groundbreaking, outweigh the immediate risk posed by its official going concern status? I'm going to argue that the tech breakthroughs and a clear commercial strategy make this company fundamentally undervalued, and that a rescue via partnership is plausible.
And I'll be taking the, let's say, colder perspective. The science might be brilliant, and I'll grant you that. I really will. But operational progress is completely irrelevant if the company runs out of cash next quarter. The financial distress, the auditor warnings, the market structure, it all points to one thing: massive dilution, or worse, outright failure. For me, the equity is simply uninvestable right now.
I see why you'd say that. The numbers on the balance sheet are alarming, I won't deny it. But let me try to frame this in terms of intrinsic value. GelTech's technology has, I think, fundamentally proven its worth. That makes the current market cap of, $8 to $10 million? A deep, deep discount to the platform's actual value.
If it survives to realize that value.
Right, that's the catch. But look at the evidence. The preclinical data they released on November 24th, it showed their gel increased bioavailability by 38 to 45% compared to leading antihistamines. Now, that's not just incremental, that is clinically transformational. I mean, think about what that means. A 40% boost lets Big Pharma lower the dose, which cuts down toxicity risk, and critically, it offers them a path for life cycle management. They can take an old blockbuster drug that's about to lose its patent, reformulate it with this gel, and essentially get a new patent, fending off generics for years. That is a multi-billion-dollar solution you're offering them. And what's more, they aren't just a one-trick pony. They've diversified across pharma, nutraceuticals, and even a pet and veterinary vertical. The deal with Healthy Extracts in the U.S., the sports gel brand sponsoring the pickleball tour, that's all designed to bring in some near-term revenue and show the platform works outside the high-stakes FDA pipeline.
And that's a compelling story. It really is. A great story about future potential. But it's a story that is completely irrelevant when you are staring off a fiscal cliff, which they are. We have to talk about the reality of their finances. You said going concern. Let's be very clear about what that means. It's not some little accounting note. It is a formal warning from their own auditors that their recurring losses and their capital deficit raise significant doubt about their ability to even exist in 12 months. This comes from 6.6 million AUD in losses last fiscal year, and a working capital deficit of about 4.1 million AUD. I mean, their short-term liabilities are swallowing their short-term assets whole. They are bleeding out. And to make it worse, the stock's been under $1 for so long it's violating NASDAQ listing rules. If they can't get that price up, and soon, we're looking at a reverse stock split in mid-2026. And a reverse split is almost always, the market's kiss of death. It's a signal that you're about to be hit with massive, catastrophic secondary offerings. I'm sorry, I just can't see how the pickleball sponsorship money is going to fix this. Let's do the cold hard math of dilution, because that's the threat that's staring them in the face right now. To raise the absolute minimum capital they need, let's be generous and say $5 million at 90 cents a share. They would have to issue over 5.5 million new shares.
Okay.
Now here's the kicker. The current public float, the number of shares out there for trading, is only about 4.77 million. So you're talking about issuing more new shares than currently exist for the public. This isn't just dilution. It's a share count catastrophe. It would obliterate any value and probably push the stock so low they'd be delisted immediately.
I acknowledge the arithmetic. You're absolutely right. Equity financing at this level would be disastrous. It would lead to exactly the failure you predict. But, and this is a big but, that math only matters if they use the conventional toxic financing routes. The whole counterargument, the entire bull case, rests on the unique value of that preclinical data. That 38 to 45% bioavailability increase, that's their licensing chip. It's everything. Management strategy has to be, and I think it is, to bypass the equity markets entirely. The goal has to be securing a non-dilutive, upfront payment from a pharma partner. That is the bull case trigger. It resolves the going concern risk overnight, stops the cash bleed, and makes your dilution math irrelevant.
But why would any sane business development executive write a multi-million-dollar check to a company their own auditors say might not exist in a year? They have all the leverage. Why not just wait for the inevitable bankruptcy and pick up the IP for pennies on the dollar?
Because of competition and time. A successful lifecycle extension is worth hundreds of millions, maybe billions. Waiting 6 months for GELS to fail is 6 months you're letting a competitor potentially swoop in. Or GELS could find a smaller bridge loan to survive. That 40% bioavailability data is a proven, unique asset. It creates urgency even when the company holding it is on financial life support. Okay, let's shift to market structure because the price action is, well, it's ugly. We both agree institutional ownership is basically non-existent, 1.1%. But I think it's important to note this isn't a speculative short attack. Short interest is incredibly low, like 0.26% of the float. So this isn't a short squeeze story. The pressure is coming from long-term holders leaving, not short sellers piling on.
That's a very important distinction about the reported short interest. I agree. But we need to look at where the institutional money is actually going. Let's look at the off-exchange, the dark pool trading volumes. Our data shows that on some days in late October, the dark pool's short volume ratio spiked as high as 63, almost 64%. Now, to be clear, that is not your typical speculative shorting. That's the footprint of market makers helping large institutions liquidate their positions quietly. The smart money is dumping their shares off exchange specifically to avoid crashing the public market. When you see sophisticated holders aggressively distributing shares in the dark, that is a 5-alarm fire. It tells you they have zero faith in any deep value thesis, no matter how good the science is. They are voting with their feet.
Okay, the institutional distribution is a clear headwind. I see that in the data. I can't deny it. However, you have to balance that against the company's balance sheet composition. A massive 92% of their total assets are classified as intangible. It's all patents, clinical data, IP. While that's illiquid, it tells you where the real value is. It's in the patent platform. That's what a partner is buying. They aren't buying a factory, which smartly GELS outsourced to IDT Australia back in July. That move de-risked their supply chain and cut their capital expenditures, proving management knows their value is in the science, not the infrastructure.
I'm just not convinced. Focusing on the IP doesn't let you ignore the huge administrative red flags. I mean, these are often the first signs of a total breakdown. They keep filing things late, like the Form NT20F, which is basically them telling the world we can't get our annual report done on time. To an investor, that suggests serious internal chaos. It suggests the finance team is overwhelmed, and it triggers more scrutiny from the SEC from NASDAQ. It just erodes confidence. And let's go back to those intangible assets you value so highly. If the market cap stays this far below book value, accounting rules could force them to take a massive asset impairment charge. It's a non-cash charge, sure, but it would deepen their reported losses, reinforce the negative story, and could wipe out their entire equity base on paper.
And that administrative strain is a real concern, but I'd argue it's a symptom of being a tiny, cash-strapped public company, not a fundamental flaw on execution. You have to contrast the paperwork struggles with their tangible operational progress. The IDT Australia deal de-risks manufacturing, the Healthy Extracts partnership validates the tech in a lower barrier market and gets them to the commercial stage. I mean, this shows a management team that is focused on execution, on actually building a business. That focus, I think, will solve the financial problems if they can just land that first big licensing deal based on that incredible bioavailability data.
The operational runway is being built, even as the cash runway is collapsing.
At the end of the day, the technology is promising, but the immediate risks are just overwhelming. You have NASDAQ delisting pressure, you have the going concern status blocking off normal funding, and you have this desperate, almost mathematically impossible need for capital. The odds are just so heavily stacked against them. I think the most likely outcome is either the slow grind of dilution and a reverse split into oblivion, or just liquidation. The technology might be a revolutionary lottery ticket, but the company holding it can't afford to stay open long enough for the numbers to be called.
And I'll maintain that the scientific validation, that 38 to 45% bioavailability data, offers them a clear, if high-stakes path to non-dilutive financing that flips the entire narrative. This company has real, validated IP, and they're executing partnerships even while teetering on the edge. The entire investment thesis hangs on them securing one transformative deal. Yes, it's a moderate to low probability, but it's an incredibly high reward scenario that could result in a multi-bagger return if it pays off. The material really shows a classic microcap biotech profile where the technical promise is matched only by the financial peril. The whole thing hinges on one question. Is the IP powerful enough to make a partner ignore the financial mess? Or is the mess so bad it paralyzes any rational investor? It leaves you with a highly speculative choice based entirely on your tolerance for imminent failure versus transformative upside.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.